To be a successful investor, you need two things: understand the world and understand yourself. But let's begin with the world first. So let's look at some trends that are happening right now. So, of course, we have the AI that requires data centers, that requires a lot of electricity, and those are investable on their own. But let's go deeper. We also want to electrify third world countries because we want to make the world fair for everyone. That's really, really good. We also want to go to carbon neutral. So this moves from non-renewables towards renewables. And there are many micro trends such as voice assistants. So for example, in future, it's likely that when you want to buy a purchase, you will just talk to your voice assistants and tell them, buy me this, this, or this. But the assistant will be the one who's going to determine who the good will be purchased from, which means that there will be a lot of competition between brands to rank higher in this search. So even the trends I've just mentioned, they're completely investable on their own. And you can get involved in those sectors and make really good money. But I believe there is one sector that combines all of these trends, and that's the commodity sector, because you need all these materials to build the data centers, to get enough electricity. And right now, there's a huge problem with the supply because it takes 10, 15, 20 years to get the mine from the moment when they find material to actual production, because they would need to get all the permits, they would need to make sure they can build the mine and make sure the mine can actually work. And so this would be an example of how you would find a sector that's underinvested, undersupplied, and combines a lot of various trends. I would also like to mention this concept of riding the wave. So you can absolutely invest in any sector at any time if you find a good company, because good companies with good management will do well almost at any environment. But if you're able to spot a trend, get involved in the sector while this trend is happening, is playing out, you can make really good money even by making a small mistake. Maybe you identify your own company, but usually during this wave, it raises all the boats and you can make really good money. And that's I'm sure that some of the trends we've talked about, that is going to happen. And I'm very sure that this will occur in the commodity sector for the long term. So this is not like 12 months, 6 months play, even though they can do really well in this period as well. And we can see what's happening with gold, but still over the long term, because of these trends, I see commodities as an absolute no-brainer. And then the second part is understanding yourself, because some people cannot be contrarian. They cannot be away from the masses. And for these people, it's absolutely okay to get involved in the general market, so the S&P 500, the mainstream companies. There's nothing wrong with that. They can invest passively into ETFs. So you can absolutely find, even if you find this trend that I'm talking about, you can passively invest in an ETF and still ride the wave without, really burdening yourself with analyzing individual companies. There's nothing wrong with that. However, of course, there's much more rewards if you can find these individual opportunities. But usually, you need to get in very early. And for you to do that, you need to be contrarian and being able to be on your own. Because if you're in early, no one gives a damn about that company or that sector of interest, and everyone believes that you're wrong because during that time, other things are doing really well. The bitcoins, let's say the general stock market, but you're in early, you're on your own, and it can be very lonely at times. So if you can identify yourself as being contrarian, then I believe the window of opportunities are much bigger, because then you can get in early, stay really, really patient. If you can buy a company and then the market gets even more pessimistic and your company of interest drops by 50%, but let's say the company is doing still fine, they just hate for one reason to another, because again, no one gets interested in the sector. Well, that's good. That's even better. You should be happy about that. It's like a sale on the shop. But most people are not able to do that, which is again perfectly fine. It's just important for you to determine if you are able to stay contrarian. And if you are, I believe the window of opportunities is much broader, and you can make a lot of money by identifying these opportunities, going in early, and by just staying patient. So, okay, we were able to identify a sector of interest. Now it's time to buy individual companies, if you are the kind of person who's willing to do the extra work. So I would really invite you to look at the company not as a stock, but as actual company and business. So if you were buying a uh, local shop, it could be absolutely anything. It could be like a bakery or whatever. What would you be looking for? You'd be looking for the margins, how much salaries are we paying, is the management good? So if you're the owner, of course, but you will still have the managers. If you're buying big companies, that would be the CEO. But you're thinking about the profitability, the management. You're also talking about the location. What can we improve? How can we increase the sales? Can we increase the price? So you're thinking about little things. So, but these are the things you should also be thinking when you're buying public company, because company is a company, right? It still runs. It needs to generate profit. It needs to generate cash flow, free cash flow, and then they can use that money to invest, to expand, get better, etc. So when you're buying individual stocks, please look at it as if it's your business. You are the owner of that business. And then when you're analyzing the stock, you will automatically and naturally be able to find these possible red flags. Because if there's something that you would do to your own bakery that the CEO is not doing to his large corporation, well, that's a huge red flag, because again, you should treat it exactly the same way. And right now, in this era of AI, you can just find the sector of interest and talk to ChatGPT. What are the top 10 stocks in this sector? He's going to give you the list, and that's how you can start analyzing individual companies within that sector. So you don't need to, like before Google, try to find things. You will get the list, and that could be your starting point from the very, very start. Okay, guys, so let's get to the company evaluation process. So this is an excerpt from my course, Wealth Building Blueprint, but I'll show you this part. So the first three steps there are like college background reading. So there is this file called 10K or annual report. So companies release this file every year. And then there's also 10Q report, which is the quarterly one. And the first part, there's a business section of the 10K report, and I'll show you. It's here. So here you can see this is an example for a company called Apple. And you would see they talk about their products, their services, the segments, competition. So again, this is absolutely background reading. You want to understand the company on a higher level. Then, so that's basically what I explained here. Then the other step would be to reach management discussion and analysis. This is also found on the same file. I don't think do they have here? Because I got it from the Apple website. Yes, they should have it. And I think this is it. Yes, item 7. So here is more background information. They told you the segments from various countries. This is in billions. That's the percentage change from different years. So this is just, again, for you to understand the company on a more deeper level. And then the third step, you will go to the company's website and you would look at the presentation, the earning calls. It's sort of what analysts believe. It's basically like a conversation between them, and they're talking about their plans for the future, what they're already doing, what they want to do, etc. These are the first 3 steps. Then the fourth step is the financial statement. So again, it's the same document, and you can get the file. I got it from the website here, but there is SEC SEC Edgar website. And here's where you can get it for all the companies as well. It's a very important website. But the step 4 would be to reading those documents and looking at the actual financial numbers. Then you would look at those. And the first thing you would do, you will look at the revenue, the cash flow, the free cash flow, how much money they're making, what are they spending on, what plans do they have, is the trend good? So you're literally looking at the trend for revenue. You can chart it on a graph. You're looking at all these numbers. Then you look at the margins. You can look at various margins. There are various calculations you can do. I'll show you a few of them as well near the end. And then you could do discount cash flow calculation to determine the fair value of the company. And then you can do the same for the competitor analysis. But in this case, some people believe that could be like wasting time. But really, the competitor analysis, you are analyzing different company, and you can easily figure out that the company you were analyzing as a competitor could be better opportunity. So you're never wasting time. You're just researching another company within that sector. And then you can look, is there possible catalysts that could happen? Maybe they're doing an acquisition, maybe there's something else. And then you're looking at the margin of safety. Is it high enough? You can determine, is there a moat that sort of protects the company? It could be its brand or whatever, or maybe it's like one of the most, the company has the most famous CEO in the sector. That could be a bad thing as well, because then if that person leaves, that leaves company vulnerable. But that's the idea. And I'll just show you a few, so that's more information we're not going to go through. But here are, for example, some of the things you can do. So you can calculate earnings per share, and I have all the formulas as well. Price to earnings, very important, but here we are sort of building up. We're using some of the information from the first calculation, then we go further and further, the PE ratio, then the PEG ratio, the enterprise value. So these are an examples of some of the calculations you would make to determine if the company is good. But just an overall, guys, the overall point is just to understand that you are looking at trends. You're looking to figure out which sector suits you personally, based on your own, personality traits, whatever. Can you be contrarian? Maybe you can't. And then you would do this company analysis where you would do these calculations. You would look at overall trends. If you're interested, guys, to go really deep into this, I have a course called Wealth Building Blueprint. I believe it's the best course in the market relative to its price. And it's almost 10 hours of information, because I have a whole 2-hour masterclass basically using this file and going deeper. It's like 2 hours. Then I have trading masterclass, ratio masterclass, precious metals masterclass, trading masterclass, overall background information. And I also offer 3 days money back guarantee, no questions asked. I don't care why you didn't like it. If you don't like it, I do not want your money, because I actually want happy customers. So that's my offer for you guys. I've spent the whole year creating that course, so I put enormous amount of effort into it. If you would like to go deeper into all of this, because I can't go through everything right now. So I hope you enjoyed the video, guys. Thank you very much for watching. I'll see you soon.